All right, thank you very much, everybody. It is April 28th, 2011. This is a co-production between FXStreet.com and FXDD. We're going to give you some great education today. Again, you'll hear a little bit more noise than usual because we're actually coming live from the trading floor here in New York at FXDD, so exciting times today. All right, our disclaimer is we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. All right, so today, Greg Michalowski is going to be teaching how to keep fear to a minimum in your trading. This is an important topic, one that is often overlooked. It is a psychological aspect, and Greg has got a great presentation coming up for you today. All right, so there is Greg Michalowski. He's the Chief Currency Analyst at FXDD, and he is known for his speaking engagements around the world, an excellent trainer. He's been in the market a long time. I'm Sean Powell, National Trainer at FXDD. Two of us have been in the markets a long time. I'll be sitting in the chat helping out as Greg presents. Okay, so we have a contest going on at FXDD right now. It's called Race to Rewards. It is for live trading accounts, and what it is every time you make a deposit into your trading account, you are entered for the big contest here. One of the prizes is actually VIP tickets to one of the next Formula One races. We just gave away an iPod Touch, and so each week new prizes come out. That's pretty exciting stuff. If you don't have a live account and you're thinking about getting one, we will do a special promotion today. All you have to do is send me an email, askpal@fxdd.com, once you've opened a live FXDD account, and we'll put $100 of real money in there so you can start trading right away. Again, just email me, askpal@fxdd.com. Okay, so without further ado, I'm going to pass off the ball, wish Greg good luck, and here we go for an excellent training.
Sean, let me get my screen up here. Good. So I hope everyone can hear me as well, and that this goes as planned. As Sean mentioned, what I'm going to talk about is fear here today. Traders have a lot of fear. Sean went through our disclaimer, but before we get into that, I'm just going to give you just sort of an idea of where I'm coming from. I've been in the business for 10 years. That's 48 weeks a year with 4 weeks of vacation, 240 days a year. We don't get any holidays in FX. They're open every day except Christmas and New Year's. 240 days times 9 hours a day, 2,160 hours a year, and 10 years of experience. That's 21,600 total hours of watching, trading the Forex market and watching what retail Forex traders do. And that is an advantage for me because I've been able to see what retail traders do right and what they do wrong. And from that knowledge, I've been able to develop what I have called is my mission statement. And my mission statement, and the mission statement for all you traders out there, should be something very similar to this, to make the most amount of money with the least amount of risk. And I use the least amount of risk. Why? Because the least amount of all businesses should be focused on not over taking too much risk in their business. If they can use the least amount of risk to make the most amount of money, that is the perfect mix for a business. And it's a generalized mission statement, as all mission statements are, but that is what you should try to do. And why? And so once I develop my mission statement, I try to figure out, well, how am I going to go about making the least amount of money or the most amount of money with the least amount of risk? And I came up with my game plan, and my game plan from all these hours, these over 20,000 hours of watching the market, was to trade the trends and keep fear to a minimum, because the trends are traders' friends, and fear is one of the worst enemies that traders can have. First, let's focus on the trends. The trends are fast. The trends are directional. Trends tend to have a low to high range that are greater than non-trending ranges, and traders make the most money by trading the trends, and they make the most money fast by trading the trends because trends, again, are fast. And so if they're fast and they're directional, all you have to do is be on the trend. Risk is actually less when trading the trends. Why? Because if you're on the trend, you're only risking a profit. You're not risking a loss. And so I consider that a different type of risk. If you're starting off a business and you have or a trade, you have risk, and that risk can lead to a loss, and that loss can cause your business to go out of business. And it's the same is true for trading. If you start off with a trade, you can lose or make money. And if you're on the trend, or when you're first starting off on that trade, you do have the risk that you could lose money. But if you're on the trend and you're trading with the trends, that risk of going out of business is greatly diminished. So actually risk is less when trading the trends. And as a result of that, what you should focus on is that your fear should also be less, because traders have to manage the profits, not the losses. And that's such a comforting thought for me when I'm in a winning trade, is that I am managing profit. I am not managing loss. So my fear gets dispersed away. And that's an important thing for you to have as a trader, because a lot of traders don't recognize that they can take start taking fear out of their mind when they're in a profit. Think positively about your trading, about where you're going, about your profit on your position, and that will automatically disperse some of your fear. And fear, you really have to try to think about ways to control your fear. So to make the most amount of money with the least amount of risk, which is our mission statement, you have to trade with the trends. And to keep fear to a minimum as well, you have to trade the trends. In summary, you only have one choice when the market is trending, and that is trade with the trends. Yet, what I found in those 21,000 hours of monitoring the market, of monitoring what you traders are, I speak you in terms of just a overall retail foreign exchange trader, is that retail traders don't trade trends very successfully. And there are a couple of reasons why. One is that they tend to take too much risk. For some reason, people think that think that 100-to-1 leverage is the answer to their needs as a trader. Quite frankly, most traders who complain about 100-to-1 going to 50-to-1, let's say if you're a U.S. client, are traders that lose money twice as fast trading at 100-to-1 leverage than they would at 50-to-1. So it's actually oftentimes and usually the people who lose the most money are the ones that tend to use too much risk in their trading. And if you use too much risk, guess what that does to your fear? It increases it. It increases it whether you know it or not. Your fear is increased. So too much risk by traders tends to cause traders to not do well, and also increase what we call fear. And the other thing that traders tend to do that makes them not trade trends successfully is they don't anticipate. They don't anticipate. And all successful businesses and athletes as well anticipate. I think I've said this before in other webinars. And traders have to anticipate too. They have to be able to anticipate a trend. If you can anticipate a move in the market, you're able to disperse some of your fear as well, because you have confidence in what may happen, and you also do things like define risk. But if you think about it, and think about it in terms of businesses, Apple is a successful business, and I can imagine that they anticipate what they might be doing as far as their products. They anticipate what the demand might be. They anticipate what the consumer might want. They anticipate what businesses might want in that iPad, in that tablet that was nothing new. There are tablets before the iPad. Granted, they made it a little bit more sleek, and maybe that was the anticipation of what the consumer wanted. But what they do is anticipate trends, and successful traders anticipate as well. And the way that traders anticipate is by listening to the market. The market does talk. A lot of retail traders tend not to listen. But if you can anticipate what may happen going down the road by listening to what the market is saying to you, and we'll go through examples as this webinar progresses, then what you're automatically going to do is start to reduce your fear as well, because you have confidence in what you're listening to. You have confidence in the anticipation of what may happen. And if it doesn't happen, you just get out. You just get out of the trade. So you start to lessen your fear, keeping your fear to a minimum by doing things like anticipating a trend. And finally, a lot of retail traders just have too much fear. You have too much fear, and you quite frankly, I think a lot of traders don't understand the types of fear they have. And what I've found and what I've noticed in the market within retail traders is that you actually have two types of fear. And most people know the first type of fear. Well, before I get to that, the two types of fear, again, I only have one screen here, so I'm forgetting the sequence of my slides. But what I want to remind everything about fear is that fear is a trader's worst enemy. So if the trend is your friend, fear is your enemy. They balance each other out. And remember, that's our game plan, to trade the trends and keep fear to a minimum. So one of the sayings that I always remind people of is that you have to steer clear of fear. It's an easy way to remember. You should be conscious of how you feel about your fear and what type of fear that you do have. So you always have to try to steer clear of fear. And most successful traders learn how to control your fear. So now I get to my slide finally about the types of fear that traders do have, and there are two types of fear that I have been able to recognize within the retail forex market. And the first one is quite obvious, and it's the one that most traders understand and think that they have. They think they have the fear of failure, and that's true. You put it on a trade, you automatically think that the long that you just took should really be a short. Because now you're buying the high, or buying near the high. There's no way that it's going to continue to go higher. I just bought the high, can't believe it. Oh, get me out, sell the market. And they sell the market, and next thing you know, the market does go higher, and they're doubting themselves. They're doubting their abilities. You're doubting your ability to make money in the market, and this is the fear of failure. You have this negative bias in your mind that says that you put on this trade for a reason. You may have all the reasons in the world, but you still have that fear, and that fear, that fear starts to dissipate with things like plans, with things like tools that you use in your trading, and we'll talk about that in a little bit. The other type of fear that traders have, which a lot of traders don't realize they have, is what I call the fear of success, the fear of your success. And what the fear of success is it's what causes traders to exit trends too quickly. Remember, our game plan is to trade the trends, and a lot of traders are not able to trade that trend for very long. I often find that traders are able to get in a trend and at a good trade location because they're used to buying low and selling high. But once the trend starts, they're not in position to stay on that trend, and they exit too quickly. And the reason why is because of this, what I call the fear of success. So fear of success also involves a condition where traders fear that their gains or successes that they have in their trade will be taken away from them by an invisible monster called the market. Have you ever had this feeling where you get into a trade, it's a profitable trade, you did all the right things to get into that trade, yet you're scared out of it? You think that you see the first little bit of a correction and the market scares you out. You fear that that monster called the market is going to take your success away from you. It's going to take your gain. You don't have a failure. You have a success. In fact, you have the best trade location in hindsight than you probably even realize at the start. But you fear the success. You fear that this monster is going to take the gain away from you. So as an example, just to show you what I mean and what the implications are of this fear of success, and it can be quite damaging actually, is take a look at this euro versus US dollar. What do we see here? We see moving averages. This is our 100, this is our 200 simple moving average. We see those two moving averages come together here at a point, 142.27 to be exact. And we also noticed that the 100-bar moving average, it was trending, the market was trending to the downside. The 100-bar moving average has been moving sideways here for quite some time, a number of hours, suggesting that the market is non-trending. You can see that in the price. We have a nice little floor here, ceiling here. And the moving averages are right, smack dab in the middle practically of that of this range here. And then we see this market start to do something different. We are staying below this 200-bar moving average. We moved above it. We moved to our ceiling. We came back down and we tested our level right here. Is that a good buying opportunity? Is that a good setup? Is that a level where you can define your risk and keep your risk to a minimum? And if you define your risk and keep your risk to a minimum, what should your fear be? Very little. So the smart trader comes in here and they buy at this point right here, and the market goes up and it comes up to above our ceiling here, but forms a little double top and kind of wanders a little bit to the downside. Fear of success traders see this double top, and they didn't have fear down here, but they have fear up here. They have fear that their success from this trade, from this move right here, will be taken away from them. They start to envision the market coming back down and moving below their entry level, and they losing that money from that great trade location that they had. They have, their mind is not focused on their success and investing in their business by anticipating a trend type move. Instead, they're being controlled by this fear of being right, and that's a bad fear, because what can happen? The market comes down because those fearful traders sell the market down, take their profit, book their 30 pips of profit, and look what they give up. They give up the opportunity for the market to really take hold and move higher and higher. They had no reason to get out of the trade, but oftentimes I see these traders get out too quickly and they leave money on the table. Not only that, what a lot of people will say to me is, well, Greg, I still made 30 pips and no one ever went broke taking a profit. And what I warn those traders is that saying, that Wall Street saying that no one ever went broke taking a profit has a inconspicuous ... at the end of it, and that ... continues with the second part of that saying. No one ever went broke taking a profit, but they do go broke after the next 3 or 4 trades. And the way that I consistently see it in the market from what retail traders tend to do on average is what they'll do is they'll take their profit at this point, and then they'll see the market move higher. They lament the fact that they missed on that profit opportunity, but then they'll start to see the correction move down. And what did they do last time? They sold. They have 30 pips in their account. They see the market move higher, and what do they expect now? They expect the market to continue to go down. But what does the market do? It's just in a correction. They sell, however. They sold here. They're selling higher here. They see the market starting to move down. It's just in their mind. It's just programmed that the last thing I did was take a profit. The last thing I did was sell. So they sell on the correction. The market corrects a little more. They feel like they sold. They're on their way to another profitable trade, and then the market moves higher, and they get to another point where the market tests the 100-bar moving average, the blue line in this chart. And what do? They sell again, and then the market moves higher again. After it bounces off that level, they anticipate the market to move below that level. Of course, it doesn't because it's in a trend. They sell again at this point. They start to average into their position. They get one other sell up here. Why? Because the market is overbought, Greg. The RSI is high. The stochastics are saying it's overbought. It's due for a correction. It's got to correct. I'm sure we're going to go back down to this point right here. And lo and behold, it never does. They get liquidated at the top. So the Wall Street saying no one ever went broke taking a profit. ... They go broke on the next 3 or 4 trades. That's because they feared success at the start, and it led to a cascading of errors when the market did trend. They weren't anticipating a trend. They were too fearful about not only their failures, but their success, and they didn't know the good from the bad. In reality, what this was, the market was saying when the market was trending to the downside was that, or non-trending at the downside, was that the market has potential to move, to trend, and they failed to recognize that. So be aware of that. Be aware that not only do you have the success of failure, but some traders also have, or the fear of failure. Some traders also, and a lot of retail traders have a fear of success. So what you have to try to do is get over that fear of success, and one way you do that is by anticipating a trend. So how do you limit your risk? How do you anticipate trends, and how do you control your fear? If you're able to do these things, they all go toward that last thing, controlling fear. If you can limit your risk, control your fear. If you can anticipate trends, you can control your fear. And if you can find ways to control your fear, apart from limiting risk and anticipating trends, you can even have a better chance of controlling your fear. And the way you do it is by using technical tools, but you need to be picky with your tools. Your tools that you do use, they should do three things, or actually four things for you. And the first one is they need to define the trend. Once again, if you're on a trend, your fear is going to be less. Why? Because you are trading with profit. You should have less fear. You should start to teach yourself to have less fear when you have profit, folks. You got to tell your mind that I shouldn't have the fear that I had when at the beginning of the trade. I should have fear. If I'm on the trend, I'm okay. I just have to manage my profit, not manage my loss. So the tool that you should use should be able to define your trend, because you want to stay on that trend. The next thing that you need to do is make sure that your tool defines risk. If your technical tool that you use does not tell you where you should get out, or the tools that you use where you should get out of a specific trade, then I always say don't use that tool. Don't do the trade. You have to use tools that are going to be able to define your risk. If you can define your risk and then you can accept your risk, guess what your fear does? It gets dispersed. I like to give people the vision of, imagine if you take a glass of oil and you pour it into the Gulf of Mexico. It is going to disperse. There is not going to be any threat to the ecology. You don't want everyone doing it. You don't want to do it every day. It still is pollution, but it's not going to hurt anything. So that's the same with fear. If you define your risk, you're probably going to have a little bit of fear, but you're not going to hurt you're not going to have that fear that's going to hurt your trade, that's going to cause you to do things that you normally would not do with an intense amount of fear. So defining risk, accepting that risk, then allows you to disperse your fear. So defining risk is very important for the tools that you use. And then you should use what I call unambiguous tools. And unambiguous trading tools are tools that tell you that you should be either bullish or bearish, that you should either be long or short. It's not an oversold or overbought tool, or an oversold or overbought tool does not tell you that you should be long or short. That just tells you that they think the market is overbought. They think the market is oversold. So what I try to warn traders and retail traders is that overbought or oversold, or even 70% correlated, are what I call ambiguous tools, and they don't do anything for you, in my mind, except increase your fear. Because if you have a market that says overbought, it can get even more overbought. And what is that going to do to your trading confidence? It's going to, shoot it right down the toilet. So what you have to do is start to think about not using these ambiguous trading tools in your analysis. And I'll show an example here of the euro versus US dollar, and this is the hourly chart, and this is recent data of the move, or of a part of the move to the upside here that we've seen in the euro versus US dollar. And at this point right here, when the market was testing this 200, moving just above the 100 and the 200 hour moving average, which by the way is a bullish signal. You move above the moving average, price moves above it, it turns a bias. from negative to positive. But at this point where the market was moving above that 200-hour moving average, confirming the move to the upside, what was the RSI doing? Excuse me, the RSI was moving into overbought situation. It was telling the trader that they should be thinking about selling the market and not instead of getting long the market. So this unambiguous tool, like a moving average, which was telling you be long, we're breaking to the upside, the RSI is telling you the total opposite thing. Now the difference between these moving average lines, which are telling you one thing, go long, and the RSI, which is telling you go short, is that if the moving average line, if the market would have gone down and actually followed along the RSI, made that correct, what you would have done is gotten out when the market moved below the 100-hour moving average. That market would have gone from bullish bias to bearish bias, whereas the RSI says just go short. And in this case, when the market continued to rally, what did the RSI do? It continued to rally. And so at each little point along this way, it said, go short again, go short again, go short again. Well, the move from here to here took the price from 144.15 to 144.47. Guess what the trader who sold the RSI is feeling during that rally? He's feeling helplessness. He's feeling anxiety. He's feeling fear. He can't get himself away from his screen. He can't eat dinner. He can't eat lunch. He can't eat breakfast. He is paralyzed by this. And it all starts with the RSI using an ambiguous trading tool that doesn't define risk. So you see the difference between an unambiguous trading tool like a moving average and an ambiguous trading tool like an RSI. One, it allows you to control your fear. The other has the potential to increase your fear. That's why I warn traders, try not to use the RSI. Use another tool that's going to tell you the market is overbought, like a double top, like a line here. This tells you that the market, and this tells you the same thing that this tells you right here, a double top, that the market has potential to go down. But what this tells you as well is when the market breaks above the double top, it tells you to get out. So in this case, although you may have lost a little money, or gotten out at break even, you may have also had the opportunity to make some money. It didn't do what the RSI did here. It tells you again to go short, and you lose more money on that trade. This was telling you to get long. This is telling you to get short. There's a big difference. It controls your fear. The final rule for tools is this, is that less is more. There is a law of diminishing returns for the tools that you use. The more tools that you use just increases your fear, folks. This is a bit of exaggeration, I must admit, but I have seen charts where there's they have this channel moving average lines. They may have Bollinger Bands in there and trend lines and all sorts of stuff in there. And then down below they have the MACD, the RSI, stochastic, and they look at all these things. And guess what that does to a trader's anxiety? They're seeing sells here, buys here, sells here. And that too many tools actually clutter your mind, cause more anxiety. You can't control your fear. Your fear increases. It's just a rule in the game. So one of my rules for the tools is that I'm only going to have three tools. I think 3 is enough. 3 will cover all the other tools. You also have to think in terms, folks, that a lot of these tools do the same thing, or they'll cause or they'll give you the same clues. For example, a double top in the last example shows you an overbought situation. You can feel that the market is overbought. You can see that the market is running into resistance at a certain level just by looking at the clues using unambiguous tools like a double top trend line. So 3 tools only that I use. I've gone through a lot of them here already in my presentation: moving averages, trend lines, Fibonacci retracements. And what each of these tools that I use do, and this is important, and this is another rule or another word that I've started to incorporate in my analysis is that they create what are called border lines. And I use the word borderline. Why? Because people know about borderlines. The borderline between one country and another. The borderline between states in the United States and another state. We know what a borderline represents. Everyone knows what a borderline represents. Well, there are borderlines in charts as well. And a borderline is a line derived from a meaningful and unambiguous technical tool that when the price moves above it, it changes the bias from bearish to bullish, or when the price moves below it, it changes the bias from bullish to bullish to bearish. So borderlines should also do things like cause the market to reverse and or should cause the price to move away from it. Note that, when you go across a border from one country to another, you rarely just stop right at that border. You move away from it. And that's what borderlines in trading should do as well. You move away from it. There are levels where the market doesn't hang around. It moves away from it. So borderlines are very important in developing that momentum and developing that momentum that's going to allow you to control your fear, because it's the market. You expect the market to move away, and when it moves away, your fear should be dispersed. Guess what happens if it doesn't move away? You start thinking about getting out, and so that also disperses some of your fear as well. So key borderline levels and key tools that develop borderline levels are going to actually move the market away. Traders who trade against a borderline also do something called limit their risk. And when risk is limited, guess what that does to your fear? Lessens your fear. Borderlines give you that bullish and bearish bias. You want to use those borderlines to your advantage. So taking a look at some examples here, here is the borderline of a trend line. This is the euro versus US dollar. Market moves higher. It creates this borderline 1 and 2. We have a price, a low here, and a higher low here. You can draw a borderline. Boom, put it in the chart. Next time the market goes up at point 1 right here on the top side, you can probably fit in a parallel trend line. In fact, once you have 1 and 2, you can go in and fit in this parallel trend line that comes to this point right here and kind of predict that not only does the market have resistance against the 200 bar moving average, it has a little resistance against the trend line here. So risk is defined. Guess what that does to your fear? It reduces your fear. Market comes back down. What is the test? The borderline again. The market finds support, and the market starts to move up. And then when the market breaks through at this point, what does that tell you? It tells you should not be short. You should go long. So if you sold the market here anticipating something like this, you get out and you get long the market, and the market uses that line as support until the market breaks down within the channel again, and the channel comes down to point 4. Gives you another opportunity to buy against the borderline. Is your fear, should your fear be less? Yes. You're buying and you're defining your risk. If the market would have gone down this way, would you have gotten out of that trade? Yes. Would you have had a loss? Yes, but your risk would be limited, and your fear would be limited as well, because you accept losses in your trading when markets don't do what you think they should do. So in this case, you buy the market, or if you were to buy the market here, you watch the market go up to 4, and at this point, would you think about selling? Yeah, why not? It's at a borderline level. Is your risk defined? Yes. Is your fear? Should your fear be controlled? It sure can, because you're trading at a borderline. You can define your risk. If it did something like this at number 4 and went above that line, you would go long. That would be the only only position that you should have. If it broke above the borderline, you should go long. This is the importance of borderlines. It controls your fear. It defines your risk, and if you do that, you'll be okay. Finally, when the market breaks below the borderline here for the first time in these 2 days here, the market starts its correction and consolidation. Borderlines are key. They define risk. And trend lines are key. They define risk, and they also keep your fear to a minimum. This is an example using a moving average. We went through the trend lines in the last one. This is the moving average. This is a 5-minute chart, and this was from yesterday, I guess. The market the last couple days. Market moved below the 100 bar moving average, started to move to the downside, found the bottom here, and then started to move back above the 100 bar moving average. What does that tell you? This borderline says buy. And when it goes above the 100 bar moving average, that's a signal to buy. So you buy on the break of the 100 bar moving average. We move above the 200 bar moving average, have a little consolidation here, You may think about getting out of the position here, but there are perhaps reasons to think that the market should go higher. But what you should recognize is that if the market goes below the 200 and then moves back above it, you should expect the market to move higher, and that's what it did. We consolidate here. What do? We test the 100. 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 We move higher. It took a while for it to happen, but did it ever give you any other signal other than buy? Were you able to define your risk? Were you able to control your fear? If you were able to define your risk and your risk was minimum, sure. Did you benefit from the trend move to the upside? If you're able to stay in it this long enough period, yes. You may have just gotten frustrated with the lack of movement, but good traders, you will live through that. They'll just understand that, hey, the moving average is moving to the upside. I'm long at this level. I'm not going to lose any money. All I'm going to do is, hope for the market to go in my favor. And if they did, they saw the move in the early Tokyo session that took the market to the upside. It continued that way until the market started to give up non-trending in this period. At this point right here, market did the same thing, moved above the two moving averages and started its trend to the upside. This is an example of a lot of things, trend lines and moving average lines, and also 38.2% retracement, the Fibonacci retracement. Dollar yen breaks through the 100-bar moving average, starts to move down through the 200-bar moving average, falls through that level, and we get the sharp move that we were expecting. This is actually a selling opportunity up here. The market is consolidating here. You may have sold and may have gotten long, but you can see how the moving average is sort of losing some of its momentum in this direction here. So it's more of a difficult trade up at this level where the market goes above and below. But once the market fell below it for the second time here, you can see that the corrective move went right up to that line, and then we get this large bar here, which actually moved a little bit below this other bar. This is giving you clues that the market momentum is changing. The market momentum is moving in a different direction than what it was prior to this move. So what you would do is maybe look in this area to, if you didn't sell on the initial break here because you're a little bit more unsure about the action here, you would be looking to be a little bit more of an aggressive seller when the market finds some resistance early resistance against the trend line here and starts to move down. You're still risking just a little bit. This isn't a lot of movement here. A lot of traders will risk more than this amount on any one trade, so it's not out of the question to do this trade. Alternatively, what you could do is use any of these other borderlines here to benefit from trade movements in one direction or the other. At this point right here, although the market moves above the 100-bar moving average, we've come a long way here, and so it might be expected that the market has the potential to move above the 100-bar moving average. So when the market does move above that does give you a bullish bias, and you may go long. But what do you do when the market fails at that level? You get out. In fact, the quickness of the break to the upside and the failure of that move gives you a clue that perhaps you should think about selling when the market moves back below. We do the same thing here, start to develop a trend line, start to develop a channel, market sells off, test it here, come back up here, break the trend line, break the channel line, starts to move up, moves to the upside, comes to the 200, moves above that 200. And what do we run into? 38.2% of this retracement move to the upside. Is this a level that you can feel comfortable selling against? Sure, why not? Take profit against that level. Broke above the 100, broke above the trend line, broke above the 200. 38.2 is the next target. Can you define your risk? Yes. Should your fear be less? Even if you're getting a short position at this point, your fear is a break through the 38.2. You sell against 75. Your risk is 85, 90, 85, 86, 87, somewhere above there. The market should break above that level. It should move higher. Would you risk that amount for the potential of a move to the downside? Yeah, it depends upon your bias, but that is a trade that you have to look for. That is a trade that allows you to control your risk, control your fear. Sean, I don't know what, I don't have a clock in here. How much time do I have, or what time do we have on the clock? All right, it's 12:50, so I got about 10 minutes. All right, so why don't I end at that point? Let me get back. Or actually, I'll take the camera off. Why don't I end at that point? Let me see. Camera is off. End at this point because I want to take some questions. But in summary, what I want to impress on you today, folks, is that fear is a trader's worst enemy. Fear will cause you to do things that you wouldn't normally do in your trading, just like fear causes you to do things in life that you wouldn't normally do. So what you have to do as a trader is be able to recognize the fear that you have and understand that fear doesn't just come in fear of success, it also comes, or fear of failure. There also is this fear of success that takes you out of good trades too soon, too quick. What you have to do is recognize that potential exists and keep in mind that trends do form, and that if the market does start to trend, you don't want to get caught selling against the trends, because trends are fast, trends are directional, and if you trade against a trend, your fear is going to go up. So be aware that what you're trying to do is trade the trends, that if you're in the trend, your fear should be less, that you're trading against the trend, that your fear is going to be more, and that if you use things like borderlines, levels, and tools that are unambiguous, that tell you bullish or bearish, that what you're going to find is that your fear is going to start to disperse, and you start to think that, hey, I don't have this fear anymore. And that's the most important thing in controlling fear, is recognizing that it exists, whether you want to admit it or not, but recognize that fear exists, and then being able to control it. And then you can tell your mind, hey, the fear is not in control of me anymore. I'm in control of it because I have defined my risk. I know where my risk is. My fear is now dispersed. So I'll end there, and if we have any questions, I'll answer those questions now. We can go back to the charts at that point. But thank you all for coming in today, and thanks to the people at FX Street for making this all possible. So I'm looking here, see if we have any questions. Okay, correct me if I'm wrong, but looking back at a historical chart is quite different than anticipating the future chart. It looks so easy. Yeah, no one knows what follows after the current bar. The dilemma with trading is always what we do now. Good question, Mike, and very good point. There are ways, however, that you can anticipate a trend type move, and by that, what I mean is that think about it this way, and I'm going to give you to kind of take you back from step to step. There are two types of markets of markets that are out there, and one is either a trending market or it's a non-trending market. And what you have to, moving along the progression, if the market is non-trending, what will it transition into eventually? We don't know when, but we know eventually the market is going to transition from a non-trending sideways market, and especially if the range is really narrow. What you can anticipate as a market, or not really narrow, but narrow. Okay, like a couple weeks ago, we had a range for a week of 165 pips in the euro. Well, that's narrow. Normally we get 120 pip range in the euro on a day, and we have 165 pip range in the euro for a week. So that was a prelude to the trend move to the upside. So traders who recognize that the market is non-trending can anticipate that the market is going to trend. And so now you take a knowledge that non-trending is going to lead to trending, and we don't know if it's going to happen, Mike. I know it, but guess what? No, every trade we don't know what's going to happen. That's what makes it so difficult. But you try to put the odds of success in your favor. So if the market is non-trending for a week, what are we looking for? We're looking for the potential for it to trend. Guess what moving averages do when the market non-trends? when the market goes in a sideways pattern. Imagine 100, the 100-bar moving average on a week that goes 165 pips. It starts to go sideways. And so what you have to, that is a clue. When you start to see things like moving averages going sideways, 100-bar moving average, 200-bar moving average going sideways, guess what that's telling you? That's telling you the market is non-trending. What do non-trending markets do? They transition into trends. You can start anticipating the potential for a trend. And so what you have to do as a trader is then look for these opportunities where the market is non-trending, where there are clues like moving average going sideways, and say, hey, I am starting to think that the future is a trend is in motion or has a potential for the future. And then you start to focus in on what the price action does. And when you get that break, when you get that bar that goes outside the range, when you start to see the moving average go from flat to moving more positive, you start to anticipate a trend. And that is important, that your mind says, I am anticipating a trend, because that allows you to stay on the trend. You are right. Hindsight is 20/20, but anticipating and being able to anticipate a trend is different than hindsight. Think of a baseball player. He goes up there thinking that the pitcher might throw him what he threw in the earlier innings. When he gets up in the later part of the game and that same pitcher's in there, he has an idea of what that pitcher might throw him. And I'm talking baseball. And so most people who hit a home run to win a game, if you were to interview them after the game, they would say, I anticipated a fastball. Why? Because in the past, this is what he did, and he got me out, and now I'm not going to fall for that. So if you can anticipate by looking at the past, looking at the non-trending market over the last week, you can start to anticipate that fastball is coming, and you just have to get the direction right. And oftentimes that's the easy thing. The hard thing is kind of understanding how to anticipate the trend. So that is my answer. There are other examples. There are other tools or other things that I look at that allow me to do that to anticipate a trend. But I don't have the time now, and Vicky's pushing me out the door. So let me thank everybody again for coming here today. Sorry for the technical difficulties at the beginning, but feel free to email me any questions that you may have, and we'll talk about it as well. I'm always available. My email is greg@fxdd.com. My website is forex.fxdd.com. That's where I put blogs. If you want to get my email distribution, get on my email distribution list, send me an email at greg@fxdd.com. But thanks again to the people at FX Street, and everyone have a safe and good weekend. Thanks a lot, Bye now.